Good morning from Chicago traders. Thanks for joining. It is Wednesday, December 17, 2014, 8 a.m. Chicago time. Derivatives trading involves substantial risk of loss and is not suitable for all investors. My personal opinions, market data, and recommendations subject to change without notice. Past performance is not indicative of future results. That news overnight, and by the way, I apologize for the sniffles and the nose blowing breaks, but it is what it is. I'm watching the market from home today, so I'm doing the best I can. Japan's November trade deficit narrower than expected, with the currency falling as much as it has. That's expected to help exports. However, the exports number disappoints today, 4.9 versus 7% expected. That's year on year, and imports negative 1.7 to 1.6 plus 1.6 expected. Today focuses on the Fed, and if any change to the considerable time language, that's going to be very important. Eurozone November final CPI year-on-year reading matches a 5-year low at 0.3%. A lot of pressure on the ECB here. UK November jobless claims change is negative 26.9 versus negative 20, so quite a bit better. The Russian finance minister starts selling up to $7 billion in foreign currency on the market. Says the ruble currency is very undervalued. Ruble firms up as dealers believe Russia is sending strong signals to the market that they will do anything to stem the ruble currency rout. The US dollar ruble pair trades below 65.5. Remember, it got to 80 yesterday. 1 second, please. Russia's November unemployment rate's at 5.2% in line. I have a hard time believing that, but it is what they reported. November CPI month on month negative 0.3 versus negative 0.1 estimated. And the current account, U.S. current accounts, negative 100.3 billion versus 97.5 billion, a little bit worse. The S&P fair value is negative 7 points, meaning the cash is trading 7 points above the futures. For those who are trading oil, Libya's national oil company says that the Waha field is shut down due to stoppage, crude output to decline. So we might have already seen a reaction to that. What's on deck for today? 1 o'clock, the FOMC rate decision, and then 1:30 we have Yellen's press conference. Let's switch over to the technical picture. So I want to go over this real quick to show you how the auction works. So what you're seeing here are little dots representing volume that has occurred since the run-up that started at the end of October. So every dot represents some measure of volume. You can see all the dots here. So we can easily see here where the volume really is. Up to the point where we sold off fairly strong. You can see that the market goes down and tests high volume areas. Once it breaks through them, it tests them from below. This happens very often. In the case of this day here, last week, it opened just above the high volume area, tests it, goes up to the next high volume area. You can see this on this bar. Pauses, moves up to the next high volume area, and then it slows down and it halts to a grind with the prior day's point of control holding buyers at bay. Next day, we open at the high volume area. We move to the next high volume area, pause. To the next high volume area, we get a small reaction to the next high volume area, and then it stops, and then that's where it holds for the day. The next day, we open at the high volume area again at 2029. We push up to the highest high volume area in this zone, and we put the point of control right up against this high volume area, 2047, before we sell off back into the highest volume area in this zone. Okay. The next day we open, test into the high volume area again, and then we see sellers. And where do they push? They push down to the naked point of control, which is the next. So we have a high volume area here, and the next high volume area is down here. They push down to it, break right through, and then it breaks right through. And then the next day it opens above and holds the high volume area for a small reaction. Then it breaks down and moves to the next area and point of control. So if you look at what it's done here, once we break through this gap zone, you can see there's a gap zone there. Once we break through, we pause at the first high volume area. This is the high volume area here. I wish I could annotate this chart for you so you can see these areas better. See this high volume area from back here? Okay, this is from way back. This comes to us from October 30th. You could see that day's point of control, this pink line, these pink lines are the point of control. That day's point of control, Monday, is in line with this high volume area. The market has memory, folks. It's not random. Okay, and the fact that it's not random creates the opportunities that we want to take advantage of. Okay, so you can see here the point of control of this day, Monday, is in line with the naked point of control from that day in a high volume area back here. Okay, and it tests as low as the next high volume area, and it overshoots it at 76 on the close. The next day it opens below it, starts to dig into the this was yesterday, starts to dig into the next high volume area. You can see here an MCHVN. And this is a this black line. I'm taking these 3 balance days, okay? So you can see it more clearly on the composite. When we take these 3 balance days, see what we've done is we've gone up. We've gone up. We then struggled for 3 days in balance, so we create a profile around them. Then we gap up, and then we balance for a couple of days, and then we start to go higher, so we create this next area of balance. But look at this. Yesterday, 68 and a quarter, 68.50, 68.75 is the point of control here. It looks like we ran right through it, but look at what actually happened. So that's the same black line here. And when we look at what actually happened in the morning is we hit it almost on the nose. Yesterday we opened, we tested down to 68.50 on the dot. This black line is 68.50 on the dot. That's the high volume node here. We found buyers, pushed up through most of the prior day's range. The over-under for yesterday was 95.75 or so. Pushes right through it, almost takes out the high, misses it by 4 ticks, and when it comes back over, then it pushes through the high volume area. So now we have a high volume area down at 56. But the bigger thing to note here is where the point of control is. Here's this point of control at this high volume node, and then we have a point of control today at the high volume node as well. What we have is, even though we have a lower low, lower high in price action, what we have is actually balance. Okay? So I apologize for the sniffles again. It's pretty bad. But there's too much action for me to just lay on the couch. So what the key element I'd like you to take away here is how the market responds to these microcomposite levels and these composite levels. It's really important to understand this. This is what I cover in those webinars on my site. And this is the basis for how I create my bias and context. Entry is a different thing. This is just creating a bigger picture bias. Now, if I take this profile and I extend it out, now we're including the volume from these days. And so we have this new, very large high volume node. And this high volume node's from 93.50 down to about 80.50. And that's where we are right now. And so breaking through 93.25 is likely to push us back to 99.50. Breaking through 80.75 likely to push us back to 68.50. And the next area, 59.25. Those are the big picture movements that are expected. Can you trade off of that alone? No, you can't. But putting these levels up as areas to watch is very important because the market moves from extreme high in volume, tests the neckline, which is we call that the low volume node or LVN, to the next high volume, to the next low volume. And then what we want to see is the market, how it rotates. So as it approaches, for example, 80.50, we want to see, especially if it's a virgin touch. In other words, it has not been here before. Example, 59.50 has not been touched since October. So we want to see how it reacts. And then I'm looking for a pattern to take the bounce, to take the long as it pushes lower. But as the market breaks through this LVN, breaks through the LVN, then I know that I'm likely to target the next HVN, the next LVN, the next HVN, the next LVN, like that, methodically. And that's what I tweet about, okay? Now let's look at the last 2 days. Man, this is tougher than I expected. I'm about to sneeze. The last 2 days, when I combine these 2 days, these 2 days are perfectly in balance. So we have to watch out for where the point of control is here. Where the point of control is here. We have to watch out for the MCLVNs, the low volume nodes that are likely to be tested in the value area because it is in balance. Then this microcomposite here is more immediate and is more recent than these dotted numbers. I have to rely on that for today's trading as long as we're inside of it. As soon as we break away, then I have to look at the big picture. 1 second, please. So today we're trading at 71.75 right now, 72. The expectation, because of the way the overnight traded, and because we're in balance, we have VPOC, overnight VPOC, all in the same area, 83 area. The market did not test that VPOC from below. So the expectation is that the market's likely to be responsive up, meaning buyers are likely to step in to retest this 83.50. Then I have to sit and watch how this 83.50 is treated. Are buyers aggressive enough to take it up through the range to the value high of that 2-day microcomposite? And that's the main trading idea for today. So I'm looking for responsive buying into value, into 83, 83.50, okay? and I'm looking for a test all the way up to this MC value low at 96. If 96 is taken back, it brings into question. So here's the first area I have to start watching. It'll be 96. Then it's likely to test 99.50. If 99.50 brings in sellers, then we're likely to go back to 83. If it does not, then it's likely to rotate down, chop, collect energy, and move on to the next area up. Okay? So that's the primary hypothesis is for responsive buying into the point of control as opposed to filling the gap, although the gap is very close. What this could do early on is it could go down, fill the gap because it's so close, find buyers back to the point of control. That would be hypo 1 as well. Okay? I'll leave you with that. I'm struggling. But I wanted to give you an idea of how this works again. Good luck today, and I'll catch you tomorrow.